A really mixed bag of news this week, with stronger business and employment data, lower mortgage defaults, and yet weak wage growth and more evidence of the pressure on households. We pick over the coals and try to make sense of what's going on. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 18th of November 2017. We start with some good news. The latest National Australia Bank Business Survey, a composite indicator that measures trading activity, profitability and employment, surged by a massive 7 points this month to plus 21, leaving it at the highest level since the survey began in 1997. On this measure, Australian businesses have not had it so good in at least the last 2 decades. There were enormous increases recorded in trading and profitability, suggesting that demand was rampant during October. However, beware, this included a massive unexplained jump in manufacturing, and the survey's lead indicators softened over the month, which, along with an unchanged reading on business confidence, raises questions as to whether the bounce in the conditions index can be sustained. RBA Deputy Governor Guy Debelle spoke at the UBS Australia conference on business investment in Australia. He argued that investment has been strong over the last decade thanks to the mining sector. This is now easing back, and the question is, will the non-mining sector start firing or not? Even if it does, they have huge boots to fill. Lucy Ellis, RBA Assistant Governor (Economic), delivered the Stan Kelly lecture on where is the growth going to come from? It's an excellent question, given the fading mining boom and geared-up households. But we got few answers. She said Australia's population is growing faster than in almost any other OECD economy. That's remained true over the past couple of years. The rate of natural increase is higher than many other countries, but most of the difference is the large contribution from immigration. Of course, just adding more people and growing the economy to keep pace wouldn't boost our living standards necessarily. Next, employment participation has been rising significantly. The increase, though, has been concentrated amongst women and older workers and is linked with the increase in health and education employment. Finally, productivity can improve, especially if innovation can be leveraged, although she noted that the rate of technology adoption has slowed since the turn of the century. The monthly trend unemployment rate remained at 5.5% in October, according to figures released by the Australian Bureau of Statistics. While the trend is down, it was not as strong as some analysts were expecting. The seasonally adjusted unemployment rate decreased by 0.1% to 5.4%, and the labour force participation rate decreased to 65.1%. The ABS also released their analysis of individual state accounts to June 2017. This includes an estimate of average gross household disposable income per capita. The variations across the states are significant and interesting. Of note is the astronomical value and trajectory of individuals in the ACT, at on average more than $90,000 a year. We saw a decline in gross incomes in WA, one reason why mortgage defaults are rising there, at around $50,000 a year. New South Wales was around the same, and Victoria was $45,000. Tasmania was at the bottom at $40,000. Wages rose 0.5% in September and 2% over the past year, according to the ABS. This was below consensus expectation and continues the slow grind in household income. For many, that's falling below the cost of living. Those in the public sector continue to do better than those in the private sector. In original terms, wage growth to the September 17 quarter ranged from 1.2% for the mining industry through to 2.7% in healthcare and arts and recreation services. Western Australia recorded the lowest growth through the year of 1.3%, and Victoria, Queensland and Tasmania the highest at 2.2%. The legislation to tighten some aspects of investment property and levy a charge on vacant foreign-owned property has been passed in the Senate. The legislation prevents property investors from claiming travel expenses when travelling between properties, as well as tightening depreciation on plant and equipment tax deductions. Foreign owners will be charged a fee if they leave their properties vacant for at least 6 months in a 12-month period. And this is an attempt to release more property to ease supply. The latest census showed that there were around 200,000 more vacant homes across Australia than there were 10 years ago. Turning to the mortgage industry, Fitch Ratings says Australia's RMBS mortgage arrears fell to 1.02% in the third quarter 2017, a 15 basis point decrease from the previous quarter. This is consistent, they say, with the 9-year-long seasonal trend where 30-day arrears has eased in the third quarter each year. They say the curing of third quarter arrears was helped by borrowers using tax return receipts to make repayments. The 30-day plus arrears was 4 basis points lower than in the third quarter 2016, reflecting Australia's improved economic environment and lower standard variable interest rates for owner-occupied lending. Interestingly, they said the gap between investor lending and owner-occupied rates has widened as the banks respond to regulatory investment and interest-only limits on new loan origination. Historically, investors paid 25 to 30 basis points premium over occupied loans, but this widened to 60 basis points in September 2017. Standard & Poor's Global Ratings said mortgage arrears fell to 1.08% in September across Australia, down from 1.10% in August. They say mortgage arrears rose in both the Northern Territories and the ACT during the September period, but they fell elsewhere. The ACT mortgage arrears rate is only at a low 0.64%, compared with Western Australia, which has the highest arrears of 2.21%. However, while outstanding loan repayments on 30 to 60-day arrears has also declined in most states between January and September, 90-day plus arrears rose in Western Australia and Queensland. This is the same as we saw recently in the bank reporting season. Standard & Poor's expects arrears to rise over the coming months as they, quote, traditionally start to increase in November and continue through to March. There was more evidence of poor mortgage lending practice this week, following the recent UBS Liar Loans research study. A liar loan is a loan that is approved on the basis of unverified and possibly false information about income, assets, or capacity to repay. This is important because mortgage delinquency and default may rise due to excessive risk-taking in mortgage lending combined with deteriorating economic conditions or due to falling income and rising unemployment, especially during a housing downturn. Connective reminded brokers of their obligations and pointed to findings from the 2016 VEDA Cybercrime and Fraud Report, which recorded a 27% year-on-year increase in falsifying personal information. Falsified documentation, particularly documents that verify a customer's income, is the most common type of fraud that a mortgage broker is likely to encounter, they said. Back in June, Equifax informed brokers at a Pepper Money Roadshow that 13% of frauds reported were targeting home loans, and there had been a 25% year-on-year increase in frauds originating from the broker channel. In the same vein, NAB has said that it's commenced a remediation program for some of its customers after a review identified their home loan may not have been established in accordance with NAB's policies. NAB has identified around 2,300 home loans written since 2013 that may have been submitted without accurate customer information and or documentation or correct information in relation to NAB's introducer program. As a result of NAB's review, 20 bankers in New South Wales and Victoria had their employment terminated, or are no longer employed by NAB, and an additional 32 bankers had consequences applied, including reduction of remuneration. NAB has commenced writing to those customers, many of whom live overseas, asking them to participate in a detailed review of their loan, which may include validation of documents submitted at the time of their loan application. Affected customers may be offered compensation as appropriate. And more evidence of the risks in the system came when the Reserve Bank in New Zealand said that Westpac New Zealand has had its minimum regulatory capital requirements increased after it failed to comply with regulatory obligations relating to its status as an internal models bank. Internal model banks are accredited by the Reserve Bank to use appropriate risk models to calculate how much regulatory capital they need to hold. Westpac used a number of models that had not been approved by the Reserve Bank and materially failed to meet requirements around model governance, processes, and documentation. And still talking of risks, there was an interesting paper from the Federal Reserve Bank of Cleveland in the US called 3 Myths About Peer-to-Peer Loans. This suggested these platforms, which have experienced amazing growth in the past decade, resemble predatory loans in terms of the segment of the consumer market they serve and their impact on consumers' finances, and have had a negative impact on individual borrowers' financial stability. This is, of course, what triggered the 2007 financial crisis. There is no specific regulation in the US on the borrower side, given that peer-to-peer lenders are not regulated or supervised for anti-predatory laws. Lawmakers and regulators may need to revisit their position on online lending marketplaces. We published 2 research papers this week. First, our Quiet Revolution Banking Channel and Innovation Report, which is available for free download. And second, the impact of rising interest rates on households. It seems that eventually mortgage rates will rise in Australia as global forces exert pressure on the RBA, and as the RBA tries to normalise rates, perhaps 2% higher than today. Timing is, of course, uncertain, but it is worth considering the potential impact. While our mortgage stress analysis takes a cash flow view of household finances, our modelling can look at the problem another way. One algorithm we've developed is a rate sensitivity calculation, which takes a household's mortgage outstanding at current rates and increments the interest rate to the point where household affordability breaks. We use data from our household survey to drive the analysis. So we start with the average across the country. We find that around 10% of households would run into affordability issues with less than a 0.5% hike in mortgage rates, and around another 8% would be hit if rates rose 0.5%, and a larger number would be added to the in pain pile, giving us a total of around 25% of households across the country if rates were to go 1% higher. Note that the calculation does not phase the rate increases in. Around 40% of households will be fine, even if rates were more than 7% higher. At the state level, we found that around 40% of households in New South Wales would have a problem compared with 27% in Victoria and 24% in Western Australia. We can also take the analysis further to a regional view across the states. And this reveals that the worst impacted areas would be in order Greater Sydney, Central Coast, Curtin and Greater Melbourne. These are all areas where house prices relative to income are significantly extended. Thus, households are highly leveraged. CoreLogic said mortgage clearance rates have continued to track below 70% since June this year. And this is a considerably softer trend than what was seen over the same period last year. There, clearance rates were tracking around the mid-70% range for most of the second half of 2016. Results across each of the individual markets were varied this week, with Canberra recording the highest preliminary auction clearance rate of 72.9%, while in Brisbane it was only 45.7% of auctions cleared. And so now to two important reports. According to the 8th edition of the Credit Suisse Research Institute's Global Wealth Report, in the year to the middle of 2017, total global wealth rose at a rate of 6.4%, and that's the fastest pace since 2012, and it's reached US dollars 280 trillion. But wealth distribution has become ever more uneven. This is reflected in widespread gains in the equity markets and matched by similar rises in non-financial assets, especially home prices, which moved above the pre-crisis 2007 level. Household wealth in Australia grew at an average growth rate of 12%, with about half the rise due to exchange rate depreciation against the US dollar. Australia's wealth per adult in 2017 is US dollars 402,600, the second highest in the world, just after Switzerland. However, the composition of household wealth in Australia is very heavily skewed towards non-financial home assets, which averages around US dollars 303,200 and forms 60% of gross assets. The high level of real asset partly reflects a large endowment of land and natural resources, they say, relative to the population, but it also results from high property prices in the largest cities. And finally, Industry Super Australia published an excellent discussion paper on assisting housing affordability, which endeavours to identify the underlying causes of affordability issues and considers some useful policy responses in the current and historical context. They rightly consider both supply and demand related issues. They call out specifically the impact of incoming migration, especially around university suburbs in the major centres, as one major factor. More broadly, they articulate the problem facing many, in that access to affordable housing, a basic need, is now more difficult than ever. And the issue is affecting household spending decisions. Key workers like police officers and teachers and nurses can't afford to live near the communities they serve. Children are staying at home for longer, marrying later, and taking longer to save for a home deposit. Many older Australians are locked into big houses that no longer suit their needs, while a greater number of near retirees are renting or paying off a mortgage. Commuters spend too much time on congested roads and trains, which are now the norm in certain Australian cities. And more Australians are renting. The report is worth reading because it knits together the complex web of issues and confirms the complexity which is housing affordability, and makes the point that there are no simple single-point solutions. And that's the point. Sure, employment looks strong, but the nature of that employment is favouring low-wage occupations. Business confidence is strong because business profits are up, but this is not translating into higher wages. As a result, wealth distribution is becoming more skewed as home prices and stock prices rise. But the risks remain. Property is overvalued, and we lack joined-up thinking to address the fundamental structural issues which exist. So meantime, we muddle on, hoping that wage growth will start to rise before home prices fall too far and mortgage rates rise. So don't look down, we're walking a tightrope. And that's the Property Imperative Weekly to the 18th of November 2017. If you found this useful, do leave a comment below, subscribe to receive future updates, and check back again next time. Thanks for watching.